This is Tom Aspray with the Viper Report Market Wrap video for the week ending March 28th. Well, a pretty ugly end to the week. Things started shifting on Tuesday on the sentiment data, and it didn't get any better. Back in middle of March, I wrote an article in Forbes about two scenarios right around in here, looking for either, a couple of strong weeks to the upside, and then a retest of the lows, or the potential for a V-shaped bottom. I was looking back at examples going back to 2016, and also 2020 after COVID. Instead, you can see that we've completed this bear flag formation lines A and B, and a new daily sell signal in the futures on Friday. This formation has targets down in the 5,500 area and then the 5,370 area. Let's look at some. First of all, look at the SPY chart. You can see these lows here. We had, stark band warnings, some of the more bearish sentiment we've seen going back to 1990. So we started to try to lift off here. Just made it up to the 38% retracement and to a midpoint of pivot resistance. I was thinking we would get up to the 581 and possibly even up to that 587 area, but didn't happen. But of course, that's why you use tight stops and good entries. This table shows our current positions and those that were stopped out last week. We took a profit on GLD. I'll show you a chart later if I remember. We got up to above its monthly Stark band, but traders were long QQQ and added to the QQQ, for 1.4%, 1.37% loss, and S-Spider. We could have used even tighter stops, but I wanted to be pretty confident that my thoughts of a stronger rally, had fallen apart, and now they have. So still have some nice long-term gains. Of course, we've given up some of those, but I do not think this is a bear market. Why do I say that? Well, with 1 day left in the month, it's clear that the monthly AD lines are not going to cross below their moving averages like they did in 2007. All are declining a bit, but still, well above their moving averages. S&P, stocks only, and of course the NYSE all. So you can see what happened in early 22. I don't see signs of that yet, but you always want to keep up an open mind. Then we had a lot more negative signals and divergences from some of the AD lines, and also from the individual ETFs. So right now, a bunch of the ETFs, the growth ones, look really lousy, but overall market, NYSE Composite, and the Dow, which is actually performing better, do not. Still, it was a rough week, led on the downside by the NASDAQ 100, QQQ, down 2.4. It's now down over 8% year to date, tied with the Dow Transportations, while the Russell, the small cap, is down 9%. Only a couple positive signs so far this year: utilities and gold. Not a combination that most of us, myself included, would have thought at the start of the new year. So if we look at the weekly chart of the SPY, we still have this negative divergence, that was formed in the highs. As the SPY made a new high, I did the S&P 500. AD line didn't. So that's still a problem. The AD line is holding barely above its exponential moving average, CMA, but is slightly below its weighted moving average. So, pretty clear levels to watch here. If we drop below the lows at the start of the year, and more importantly, these lows back in here, it'll put these into a new downtrend. We have a high, we have a low, we have a lower high. Now, if we get a lower low, that'll be much more negative for the market. So, given the high bearish sentiment, That doesn't seem quite as likely in here, but it's always possible. The chart of the QQQ looks even worse. You can see it had a very anemic rally. I should have was probably excluded with last week's close that we weren't going to get the rally I was looking for. I thought we could get up to the 20-week here. That's still a key level. Good support here, in the 448 area, about 4.5% below where we are now. That goes back to this high and this low, and of course the lower weekly Stark band. We tested that. That set up, a slight bounce in the Qs, much better in some of the other averages. And you can see the 80 line here is negative. Here's its key support level, quite a ways above it. In this week's contribution to Forbes, I talk about my the scenarios from mid-March, why it didn't work, and looking forward to what's going to happen in the second quarter. We haven't seen these sort of declines, on a quarterly basis since 22, and some of the decline takes you way back to the 1990s. If you want to find this article, I'll provide a link, but also you search Forbes Tom Aspray, you'll see all of my past articles. The sentiment numbers we're seeing right now are similar to what happened in the fall of 1990. It's the so-called Bush 1 recession. You can see we also got down to the Stark bands here. Sentiment was as negative as it is right now. And if you look at a daily chart, you can see right in this October-November period, we started to rebound. And the recession was officially over, I think, in early January. And, of course, we moved sharply higher. That was the kickoff for the dot-com bull market for a good part of the 90s. Before I get too far away from this weekly chart, so, we drop below this support to kind of reiterate. That's going to be a much sharper decline. Then we're kind of looking down in here in the 520, down to 490 area. However, if we break out above this high and exceed this high we had in November, then it's clear sailing. And that's what we've seen, the end of 2018 to early 2019, post-COVID, etc. You can see from the daily chart of this SPY, we just barely made it above the 20-day exponential moving average, formed a doji sell signal, and the selling was pretty heavy. The volume, one of the few positives, the volume wasn't as heavy as it was back in March, but it's always possible we'll see a drop to new lows and we see an upside reversal maybe on the widely watched April 2nd, but I think that's we'll examine the evidence if that occurs. You can see still a negative trend for the SPY, drop below its moving average. The stocks only continues to act weaker, as does the stocks all. So, we're watching these levels here on a further decline. Both the VIX and the VXN turned around sharply on Friday, moved back above their moving averages. So, momentum is shifted back to positive. You can, this is a half full, half empty sort of scenario. If you're thinking this is a bearish development and major new uptrends in the VIX, the VXN, you couldn't argue too strongly against it. We came right back down to the breakout level here and then moved sharply higher. So we'll be watching as we get into the high 20s on the VIX to see whether we can reverse that. Still would think, given if the sentiment wasn't so low, I would say a breakout would be more possible. Given the current readings, I think it's less likely. But I'm not going to trade based off that. Selling was moderately heavy on Friday. 64% of the S&P was down. That's the worst since early March. S&P 1500, it was lower. And then in the QQQs, 78%. So you can see this little burst up here. These two back-to-back days here have a really good record for performance a month, 3 months, and 6 months out. And so that As I mentioned a couple of weeks ago, the rebound in the New York Composite was a bit better. You can see we hit this strong support down here that goes back to early in the year and then back into July and August. And, so it's still well above those lows. AD line here, as I said, below its moving average, above the support and the key support at these two lows. High-low analysis got a little worse last week, 137 on Friday. So we don't want to see this get back above 200. If it gets back above 200, that'll, it probably increase the probabilities we'll take out this support or at least test it. New highs, about what you expect, 40. So, you're looking for a move above, 150 or so to turn that more encouraging. On the sentiment front, you can see the AEI numbers improved a bit. I mean, they got less bearish, more bullish. Up to 27 here, and the ratio now is above that key minus 30 level. However, after we close on Friday, you can't rule out another drop back into those same extremes. Looking at the sector report, not a lot of green. You can see the gold shares, green across all, silver, green across all, and energy, 4 hour is negative, the rest is positive. Then we have consumer staples, 4 hour, daily, and weekly. A few in the weekly category here. Consumer discretionary just gave a new daily sell, as did the industrials, financials, XLC, XLB, and VWO. So healthcare also, and it's bears some watching. It's still well above its lows and key support, but has just been kind of drifting lower. And if we're going to see some turn of first things to look for are the 4 hour buys and then the daily. So I'll keep you appraised during the week. If you look at the run of overall percentages for the ETFs, only a few improved. Energy up to 83. A lot of these either stayed the same. XLY at 25, XLP at 50 and 50. XLV did decline to 25. So, it's been kind of flirting with that. So I'd like to see a rebound there. XLF, up a bit. XLK up also, but from 8.3. Other than that, XLCs, holding above the 50 level. XLU, at 66.7. So, not a lot of bright spots in that field. There are some interesting developments in some of the RS thing. For the first time in quite a while, you can see that, the consumer discretionary, the fast MA moved above the slow. Too early to say that's a bottom, but it suggests you could see one in the next month and a half. Materials, pop back above its moving average. Financials, looks better than you would expect. Technology still looks pretty weak. Looking more closely at the sector report, you can see, energy is pretty strong, 75% weekly, 83% in the 3-day positive signals, 75% in the daily. So, there's a few that haven't done as well as I expect. Unfortunately, one is one that I recommended, PSX, but that happens. Hess, so there's quite a few, looking at, they haven't really broken out through price levels, so there's still some opportunities there. Materials, an awful lot of red. We have copper, obviously, and Newmont, but not a lot else happening so far. Same thing with the industrials. We have Boeing got the big contract. Deere, just flashed a negative 3-day DTS. So, this is a trend that's basically would be negative for Deere in the week ahead. You have a daily negative and a 3-day, suggesting that the weekly may flip too. And also for United Pacific, we have a daily negative and it closed back below its pivot. Consumer discretionary, as I said, they're a little green, so it's not totally, McDonald's is about the only one that's really crossed, and the auto suppliers here are all back in the green. So staples, hit and miss. The chart looks pretty. It flipped back above its moving average here. So obviously, if the market declines, it's a pretty defensive sector. So Walmart's all and Target are all red. Costco is has a daily DTS. So you'll be looking for a 3-day to suggest that pullback is over. Healthcare, lots of red in the drug manufacturers, from Lilly to Merck to Pfizer, etc. Not surprising given what they're doing with the healthcare structure in the country, but Abbott is one of the few that's positive there, and the financials, MasterCard and JP Morgan. A few of the banks are trying to turn. There's some positive dailies, but I think it's going to need more. Nothing much in the tech. Cisco and Apple, have daily DTS. Advanced Micro has got a 3-day. And back in the utilities, lots of new, so if you look at, Duke, AEP, EXC, they're all new dailies with the rest of them positive. That's usually, they've had a pullback and a sign of a resumption of that uptrend. So, and lastly, real estate, some of the REITs are looking pretty good. Other ones not so great. AVB has a daily, but negative weekly and a 3-day. So, and it has a 1-hour positive. So, overall, the REITs are 50% 3-day positive and 50% weekly, 41% daily. There is one trend I want to discuss before we close for the week, and that's the consumer confidence. Of course, it dropped sharply on last Tuesday and then sort of confirmed by the action in the sentiment index. You can see what's happened. I saw an improvement into September, but it only lasted 2 months, so it's been pretty much declining since then. What I don't like about this chart is, what happened in 2005. It shows a very similar pattern here. So, we dropped below the low we had in, 20, of course, the COVID low. That would be more negative. Frankly, I think it's, it's overdone. You can see that if you read the depths of this, you'll see that, their expectations for inflation are like 5%, and, they're pretty highly pessimistic on the chart, on the prospects for our economy, etc. So, short-term swings often corresponds with corrections, but still keep an eye on it. Well, that's all I have for this week. This is a pretty good site, bought out by somebody recently. It's called Advisor's Perspective. I'll turn you up to the, here we go, Advisor Perspective. Really designed for money managers and etc. But some great quotes. You have to search around to find stuff, but you might find it a good resource. So if you want to subscribe to either of the publications, you can go to theviperreport.com, and we'll have a new video next week. I'm working on a video, or an article rather, on growth versus value for the second quarter. Hopefully be out by Monday. Thank you very much.